Well, I think gold was a little bit of a crowded play. I think the whole kind of world economy, when they get nervous, they move to gold. So that is, that's where I think a lot of emotional money has been moving. So I think it's just that everybody who piled in is now nervous, and now they're kind of quickly pulling back the reins. And whatever moves up the most is usually the one that pulls back the most. And gold has definitely been outperforming. When price runs up and then gets slammed down and then runs up again and gets slammed down, that's usually a sign that the market is a little bit exhausted. And the big question is this an exhaustion move and it's going to break down and unwind like I think it might? Or is it just a pause, a consolidation before it pushes up for that next leg higher? And
in recent developments within the precious metals market, a noticeable divergence in the price movements of gold and silver has caught the attention of analysts and investors alike. Over the past few months, while gold has experienced a significant sell-off, silver has largely remained stable, breaking from the typical trend where both metals usually trade in sync. Chris Vermeulen, a market expert, attributes this pullback in gold to what he describes as a crowded trade, a situation where an influx of emotional investment, driven by the fear of missing out, FOMO, caused gold's rapid price increase. Vermeulen further emphasizes that gold has been the primary focus for investors, particularly due to its reputation as a safe haven asset during periods of economic uncertainty and market volatility. As concerns over inflation, geopolitical tensions, and market instability mount, investors flock to gold as a store of value, causing sharp price movements. While historically correlated with gold, silver has shown more stable price fluctuations in recent months, indicating it may be in a consolidation phase or a more balanced market view compared to gold's erratic behavior. While speculative interest in silver is lower than in gold, Vermeulen suggests that silver could set the stage for a potential breakout if it moves beyond its current consolidation phase. Despite the recent pullback in gold, Vermeulen remains optimistic about its long-term prospects. While acknowledging the possibility of further short-term declines, he stresses that gold is still in a bullish market phase overall. Drawing from historical trends, Vermeulen notes that after a brief correction, gold has historically continued its upward trajectory, especially when global financial instability and inflationary pressures resurface. He compares the 2008 financial crisis, when gold experienced a 34% correction but rallied significantly as the stock market collapsed and financial uncertainty spiked. Vermeulen suggests that a similar pattern could unfold in the coming months, with gold undergoing a correction alongside stock market volatility. However, once the market stabilizes, the demand for gold as a safe haven asset could lead to another surge. Now, we present the clips from Chris Vermeulen's interview with Liberty and Finance. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
yeah, well, I think gold was a little bit of a crowded play. I think the whole kind of world economy, when they get nervous, they move to gold. So that is, that's where I think a lot of emotional money has been moving. And there's been a lot of FOMO. A lot of people I talk to who aren't in gold have been painfully watching it go higher, and they all want to get in. And so I think we're just seeing some profit taking. We've had the news with the tariffs, kind of another delay, a pause of tariffs. And so that is strengthening the U.S. dollar. The dollar is going up, so gold's falling in kind of the inverse relationship. So we're just seeing, I think, some profit taking, people moving out of that play, thinking there might be some good news that come out of the China tariff deal down the road. So I think it's just that everybody who piled in is now nervous, and now they're kind of quickly pulling back the reins. And whatever moves up the most is usually the one that pulls back the most. And gold has definitely been outperforming. Silver has been struggling, and so that's I think the reason for silver really just holding its ground today while gold kind of takes a bit of a beating. If we take a look at the gold market, if we pull up gold here, gold has had a very nice move. It's recently pulled back. We've been slowly kind of actively trading this. We did get into a gold trade. We closed some out a few days ago, and gold has kind of made this, is having a pause. This is a significant level. Gold could still consolidate here and move up. Based on the charts, gold has the potential to rally to $3,750, which is a substantial move to the upside from where we are right now. That's somewhere up to this range. So Gold is in a bull market phase. You don't want to bet against it. Um, uh, what's really interesting, Elijah, is when we look at the monthly chart of gold and kind of zoom out on the big picture. I think you and I may have touched on this before, but I use Fibonacci extensions, which is the golden sequence, to identify where price targets for gold are to the upside. And we've hit multiple 100% measured moves in gold over time. And these levels that I'm drawing are kind of where gold has hit rough Fibonacci targets. And what's really interesting here is each time we've hit a target and then gold has blown past it and become that kind of crowded play where we really just see it kind of drift higher and move up. Each time it's done this, including the big one we've seen right now, has been about 22 to 24% move to the upside from the 100% targets we were looking for. And so I find it very interesting that each time we've done this, we've gone into a multi-year pause or a financial reset. And it's not that everybody in the world is like piling into gold. It's actually, a very tiny percentage of most portfolios, most advisors. But the thing is, people who do hold gold right now, they know we're in a bull market phase and they don't want to sell it. And so it doesn't take much buying for gold to just quickly drift higher, because anybody who has it says, well, I'll sell it to you, but give me, pay me through the nose for it. And so that's why we see gold in these phases here drift higher very easily. So I am, based on that, short-term wise, as I told you, I think there's potential for gold to maybe push a little bit higher. But overall, based on historical price action and percentage moves, it is indicating that gold may have actually kind of had the top here, and we're going to see a bigger pause and correction with the overall economy and the stock market, and pull back and give us a pause. The last time we've had a pause like this, where we went into an economic kind of crisis and a financial reset, was in 2008, and gold pulled back about 34%. So in a perfect world, that's what we'd see here. We see gold pull back with the stock market over the next 4, 5, 6 months, and then gold would probably be off to the races after that. So short term, you don't want to bet against it. It's still bullish, but when you look at the big picture, all the signs are there, including these monthly charts, these candle wicks. If we just zoom in, when price runs up and then gets slammed down and then runs up again and gets slammed down, that's usually a sign that the market is a little bit exhausted. And the big question is this an exhaustion move and it's going to break down and unwind like I think it might? Or is it just a pause, a consolidation before it pushes up for that next leg higher? And
Chris Vermeulen is much more concerned about the recent rebound in the US dollar index, which has risen above the crucial 100 level after briefly dipping below it. This rise has captured the attention of financial markets, especially as analysts were previously concerned that a sustained drop below the 100 mark could signal ongoing weakness in the dollar. Vermeulen attributes this recovery to economic policies, such as tariffs, aimed at strengthening the U.S. economy, although the long-term effects of these policies remain uncertain. Despite this uncertainty, the dollar's rally is likely to exert downward pressure on precious metals, particularly gold, which often moves inversely to the dollar. Historically, gold prices tend to fall when the dollar strengthens, as seen during past economic crises like the 2008 financial meltdown and the COVID-19 pandemic. This trend could challenge gold investors, especially if the dollar maintains its strength over the coming months. However, despite the short-term challenges that a strong dollar might pose for gold, Vermeulen sees potential opportunities in the current market. While a strong dollar could suppress gold prices in the near term, it may also create favorable conditions for other investment opportunities. For example, if gold faces temporary declines as the dollar strengthens, it could present a buying opportunity for long-term investors who believe in gold's eventual resurgence. Historical data shows that after gold experiences such pullbacks, it often rebounds once broader economic instability or crises trigger renewed demand for safe haven assets. Vermeulen suggests that patience and strategic investment can pay off, as gold has a history of regaining momentum during times of heightened economic uncertainty.
I've been pretty bullish on the dollar. I mean, it's been beat up from the tariffs, and a lot of, I think, investors thinking it's putting the U.S. into a worse position, and who knows, probably is, or has, or done, or I don't know what it's going to do. But in the grand scheme of things, I think the president is trying to make America great again, or strong, and he's trying to level the playing fields with tariffs. And I don't know what is right or wrong. I mean, it's a huge game. In order to make things better, sometimes you got to make things worse to get to where you need to go. But I think the dollar has broken that 100 level. Everybody was watching. It made them all bearish and spooked them out. Huge volume in selling the dollar futures. Everyone was very bearish. Nobody wanted to own it. It broke a couple very significant price levels on the charts from years ago. And that also created more panic. And that to me is a contrarian play. I think it is, everybody who's wanted to sell it is now out. It's broken. It's flushed the markets. And I think the U.S. is trying to firm up their country and the currency, and I think the dollar could rally here. So I like the dollar. It does look like it's moving up, and if it does, it's probably going to put pressure on gold. And we have seen the dollar rally very significantly during stage 4 declines. Every time we've gone into a stage 4 decline, the tech bubble, the financial crisis, even COVID, we see the dollar shoot higher. And of course, that's not good for precious metals. So yeah, I mean, I think it kickstarted things. Things way before this, and you and I have talked about this for months, well before all this started, is everything that I follow, from the technicals of different money flowing between different assets and different commodities, all the way to like real estate and economic data, has been showing to me that it's been slowing. The tide has changed. It's gone from, strong economy to a kind of a sideways weak economy. And I believe everything now is sloping down in terms of all that kind of data. So things were slowly breaking down and weakening. And then I think the whole tariff thing was just enough to kind of, snap that trend and kickstart that first drop. And so now the markets are trying to claw their way back up. And the news that we have going on right now with the China and the US, this huge pop in the equities, is sending price up towards 150, 200-day moving average. It's broken a previous high from a month or two ago. Everyone is getting really bullish, and this is what the market is best at doing, is getting everybody really bullish again and get them sucked into the market just before it rolls over and goes off a cliff. And we're seeing big distribution selling. Institutions are unloading massive volume in overnight trading. Stock market was trading higher overnight. We keep seeing big bouts of high volume selling on the futures markets. And during regular trading hours today, the market's getting hammered. And then with big selling, and then they let the market drift higher. Retail buyers think we're starting a new bull market. And so the institutions are unloading into this buying pressure. And this news is exactly like what happens to the average investor. It gets them all excited. They get long, and then the market reverses and crashes a few days later. And they're like, how did I just buy this high again? And the market's falling. So that's what people need to be aware of. And we're seeing it on even our custom indicators. It tells us that there's FOMO in the market. If people feel like they're missing out and they don't care what price they pay for stocks, we have that spiking today. And every time we see that spike, the market takes a pause or pull back. And it's a warning sign to be very cautious.
Gold has been attracting significant attention due to several factors suggesting its price could continue to rise in the coming years. Experts have highlighted unpredictable U.S. policies, inflationary pressures, and the growing trend of central banks increasing their gold holdings as key drivers behind this bullish outlook. Goldman Sachs, for example, has forecast that gold could reach $3,700 per ounce by the end of 2025, with even more aggressive predictions if the U.S. faces a recession or if the trade war escalates, possibly pushing gold as high as $4,500 later this year. One of the main reasons for this optimistic outlook is the relatively small size of the gold market compared to the U.S. stock market. Even a modest shift in investment from stocks or bonds into gold could cause a significant increase in its price, further highlighting the potential for substantial gains. That's it for today. Share your thoughts on Vermeulen's prediction on gold and silver prices in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.